Good morning, everyone, and welcome to the Daily Hunt for Multibaggers on this Friday, February 13th, 2026. We've got a packed show for you, diving into the social sentiment and market data from yesterday, February 12th.
That's right, Ethan. It was a pretty active day on the boards, with a good number of posts flagging several different stocks. We saw some significant swings in sentiment, from extreme optimism to heavy caution, which makes for a fascinating, if somewhat risky, market landscape for today's deep dive.
Kicking things off, let's talk about Netflix, NFL. We've seen a lot of discussion around it. Users were celebrating major gains on bearish positions due to a recent price drop. Now it's definitely been on our radar, with its rating bouncing from stay away to cautious buy. The long-term growth story is still there. The company is still growing, and there's chatter around potential acquisitions. Plus, insider trades show a net purchase of over 750,000 shares in the last 6 months, which, is a vote of confidence.
Well, Ethan, while those insider purchases are interesting, the immediate data is quite stark. The current price is practically at its 52-week low, and the PE ratio, even after that drop, is still above 31. That suggests it's not necessarily cheap. The beta is also high at 1.71, indicating significant volatility. User sentiment is overwhelmingly bearish due to recent losses from that sharp decline. Until we see a clear reversal in that trend, and perhaps some stronger positive catalysts that justify such a high PE at these low levels, my KPIs are flashing red.
So for today, considering that immediate sentiment and current price point, our verdict for Netflix, NFL, is stay away.
Next up, we had a lot of back and forth on Toronto Dominion Bank, TD. One post was from a user shorting TD, expressing concerns about low-volume fake strength. But then, almost immediately, we saw another post titled, "I was wrong on TD puts," with users vehemently defending Canadian banks.
And that's where my optimism comes in, Brooke. That second thread really highlighted the resilience. Users were saying Canadian banks don't lose money and calling them money printers. Looking at the data, the stock is practically at its 52-week high. What really caught my eye, though, was the massive insider buying. Over 33 million net shares purchased in the last 6 months. That's an extraordinary sign of internal confidence. They've got a solid dividend yield of over 3% and a reasonable PE of around 11. It seems the market is recognizing its inherent strength. We previously had it as a buy on February 10th.
I agree, Ethan. The data really supports the bullish rebuttal. The 4,360% increase in net shares purchased by insiders is incredibly compelling, signaling strong belief from those closest to the company. While the initial bearish sentiment was present, the strong net profit margin of 0.32 and the fact that its current price is almost at its 52-week high demonstrates clear fundamental strength and positive market momentum. It's a stable, profitable institution, and those KPIs don't lie.
Given that strong data and the overwhelming insider confidence, our verdict for Toronto Dominion Bank, TD, is a clear buy. This is an upgrade from the mixed signals earlier this week. Now let's turn to Tesla, TSLA. We saw posts celebrating major gains from swing trading, and users calling it a king and a safer play. The belief in Elon Musk's vision, for humanoid robots and the semi, is still a powerful narrative for a lot of people. It's a growth story that's always got attention. Ethan, I have to pump the brakes on that safer play idea. The data paints a very different picture. Tesla's PE ratio is an astronomical 401. And to compound that, revenue growth is actually negative at 0.031. That's a huge disconnect between valuation and current financial performance. We're also seeing leadership shakeups, executive resignations, and even Elon Musk himself warning that the cybercab will be agonizingly slow at first. This isn't just a speculative gamble anymore, which was its previous rating. These KPIs, combined with the news, suggest significant underlying challenges that outweigh the speculative gains some traders might be making. You make a strong point, Brooke. That PE is certainly hard to justify with negative revenue growth. The market volatility might present opportunities for aggressive swing traders, but for broader investment, the risks are just too high right now. Agreed. Our verdict for Tesla, TSLA, is stay away. Moving on to Amazon, AMSN. We had a post about a super bullish options bet hoping for an 8% jump. From a growth perspective, Amazon continues to expand into pharmacy and AI health, and AWS is still a powerful force. Its revenue growth is a robust 13.6%. That shows continued strength in its underlying business, which is what I always look for.
While Amazon's long-term business trajectory certainly has potential, Ethan, the user sentiment around that 8% jump was overwhelmingly bearish, calling it pure gambling. The PE ratio is still a high 28.47, suggesting a lot of future growth is already priced in. An unprompted dramatic price surge is simply unlikely without a major catalyst, which wasn't apparent. Its beta is 1.385, so it's volatile, but that cuts both ways. For anything other than a very long-term patient approach, the short-term speculative bet is just too risky right now, particularly with news indicating concerns about AI investment costs.
Okay, so for those speculative short-term plays, our verdict for Amazon, AMSN, is stay away. Next, let's discuss Arista Networks, ANET. We saw one user hoping for the stock to go down, implying a short-term bearish stance after an earnings pump. Yeah, but the news tells a different story on the fundamentals, Brooke. ANET actually beat Q4 earnings and revenue estimates, and there's strong AI demand shaping its outlook. Rosenblatt even raised its price target. This is a company showing strong growth potential, with revenue growth at 27.5% and a very healthy net profit margin of almost 40%. They're performing well in a growing sector.
They are, Ethan, but we have to look at all the numbers. That strong run has pushed its PE ratio to over 53. That's a premium valuation, meaning a lot of future growth is already priced in. Also, looking at the past 6 months, insiders have been net sellers, with more shares sold than purchased. While their earnings were good after such a jump and with those KPIs, entering now might expose you to more risk than immediate reward. The user who wants it to drop might not be entirely off base for the short term, especially given the current valuation.
All right, Brooke, given the stretched valuation and insider selling despite the strong earnings, our verdict for Arista Networks, ANET, is stay away. Now for Fastly, FSLY. This one has been quite the story. We saw a really comprehensive bullish post about it being an AI beneficiary trading at a SaaS shitco valuation, highlighting accelerating revenue growth and improved gross margins. And you know what? Comments came in confirming the stock continued to rocket higher after the post was made. It's an underrated AI play that seems to be catching serious momentum, with Q4 revenue growth at 23% and significant RPO growth.
It's true, Ethan. The recent market reaction and user sentiment are overwhelmingly positive for FSLY, which is a new one for our radar. While it is still unprofitable on a GAAP net profit basis, the news of swinging to Q4 adjusted profit and improving gross margins shows a very positive trajectory. Its price-to-book ratio is still relatively modest at 2.55 compared to some peers, suggesting there could be room for a re-rating if this momentum continues and profitability improves. This is a situation where forward-looking analysis suggests potential improvements to those profitability KPIs.
Absolutely. For Fastly, FSLY, with that strong growth, AI tailwinds, and improving financials, our verdict is buy.
Finally, let's talk about Nebulous Group, NBIS. This stock had a very polarized discussion. Bullish users are touting its hypergrowth potential and massive future capacity expansion, with some predicting $1,000 by 2030.
Exactly. They're making huge investments in data centers, acquiring companies like Tavily, and targeting the fast-growing agentic AI market. This is a company building for the future. And some users are right. Hypergrowth companies are valued differently than mature ones. We've had it as a speculative gamble previously, but that potential is still there.
But Ethan, the concerns are significant. The market capitalization is over 40 times its full-year revenue, giving it a price-to-sales ratio of around 42.6x. That's an extremely high valuation, even for hypergrowth. The company is deeply unprofitable across the board, with a widening Q4 adjusted net loss. And all that massive capital expenditure is funded by convertible notes and equity sales, leading to significant shareholder dilution and a high debt-to-equity ratio of nearly 95%.